my jam, I feel good. How you feeling?
Hey, what's up, boys?
All right.
Oh,
How about that? You see how quickly we get that done, Todd?
see what I deal with on a daily basis, Todd?
Razor sharp focus over here.
That's how
Razor sharp.
the best organizations are made that way.
What's up, Todd? What do you got cooking? Long time no see.
Well, hey, how's dad life treating you? Congrats.
Dude, dad life is so awesome. I got nice spit up stains right on the shoulders. You know, a lot of shoulder stains these days.
It just wait until the food starts. Real food.
It's really going to start coming out.
Yeah, well, then it gets on the hands and.
What's harder, being a dad or being a technical analyst?
Oh, being a dad.
Technical analysis is easy.
Yeah, it's a little more process oriented. The dad has a lot of wild cards.
A little more process oriented. That's a good way to put it. I hadn't thought about that. Being a father is kind of a shit show.
The charts are static once the price is in, right? I mean,
baby doesn't care about mommy and daddy's schedule. I know.
No.
Babies are very selfish that way.
They want their attention, and you keep feeding them, entertain them in new ways, especially as they start crawling and walking. Just wait, I'm telling you, like, oh man, it's exhausting.
I love it. Strazza, one day you'll be calling us. You'll be like, all right, and we'll just be laughing at you. You'll be like, ha ha ha.
Yeah.
I have this white wall behind me because in front of me is just all kid stuff.
That's really funny. But let's talk about some adult things. You know, a lot of conversations at night revolve around bottles and babies and boobs and all sorts of scientific stuff that I never thought I'd think about. So adult conversations about business really have been quite a treat, you know, for me. You know, kind of.
You learn to like the little things. Just reading a book in silence is the new, like, going out to a bar, basically, once you have a kid.
He's right.
They're just the little things of just no noise.
No sound, just silence.
Yeah, just you and your thoughts is when you really learn to appreciate those things after a child.
Well, talk to me about those thoughts. What's going through your head? Here it is. It's September the 9th of 2020, I believe. What goes through that head of yours, Todd? I always want to know, what's he thinking? What's this guy? What are you doing?
Gosh, everything. I think the biggest, our most important thought is the
Japanese small cap industrials.
Oh, there are some good industrials in Japan and in Europe. We just went through some today, and they look pretty good. Especially you start putting them in dollar terms, starting to test the highs from 2007 and 2000 in some cases.
All right, well, let's get back to America, because the reason for this conversation, Mr. Strazza, we talk about sector rotation a lot, both internally and publicly. A lot of people have a lot of opinions, a lot of things to say. I like how we do it better than how most other people do it. You and I and Strazza, we kind of approach it from a similar lens, but let's hear it. Talk to me about sector rotation.
I think the most important thing, we can take it from here wherever we want to go, is this idea that outside of tech, you have industrials, materials, non-Amazon discretionary, all coming out of a 2.5-year bear market, right? A lot of the names peaked in January 2018, as we all remember.
I mean, the market isn't parabolic and all stocks do is go up? You mean
nope.
They went nowhere for 30 months, really?
I think that's really overlooked. EM, Europe, Japan, all these cyclical bear markets for the last 2.5 years. Yeah, Hong Kong. And the end of that bear market was punctuated by what we saw in February and March. The huge crash, spill, the climactic end to that for those sectors. At least that's what we're going with here. And the surges you've seen are coming out of that bear market for specifically those sectors. And that's what's important here in terms of the durability of the move we're seeing, and then how they're joining tech in the move upward.
Similar to the 2016 lows? Not to steal Strazza's thunder here, but similar to that, like they were completing a pretty gross bear market.
Yeah. And you saw, I wonder if the deterioration was more clear in 2015 and 2016. That was when the famous acronym was born that everyone loves to use.
Which one?
FANG.
Oh.
Right? I think that was when it was born.
I feel like every day there's a new acronym.
Oh, yeah.
The kids these days are always coming up with new stuff. Can't keep up.
But the idea being 2016, and what was at the bottom was in February, that we came out of that and we had a nice run for the next 2 years. And so I don't know how long this run will last, but I think you have to be of the view here that we just finished something that was 2.5 years long for a lot of names.
Strazza went back and listened to the podcast you and I did. When was that, Strazza?
That was summer of 2018.
And what were we talking about?
A lot of things that sound kind of similar to today. So, Todd, you were making the point back then about how there was a lot of noise, in the media and just around markets in general, that FANG was doing all the, heavy lifting, right? And then you had kind of said the best players are supposed to score all the points. That's healthy. And, the narrative was that there was narrow breadth at the time, and you were saying that's not really the case. Look at the equal weight, this and that. And I feel like we're in a similar situation today where there's a lot of noise about narrow breadth, this and that. But what's different is, the FANGs have been scoring all the points, mega cap tech, but we just kind of saw that cool off a bit since the market broke out. If you look at since the market made new all-time highs on August 21st, we have Apple, Amazon, Microsoft, they're all down 5 to 10%. So if they make up 25% of the S&P, what does that mean? And is sector rotation really healthy if it means that these names are no longer going to be participating?
Yeah, so let's see, I have two thoughts on this, right?
All right.
The tech weights are obviously important. Apple's 7% of the S&P. You need it to work. If we're going to bring out an example from last night, JC's Miami Heat, no Giannis in the Bucks. We saw what happened, right? The best player wasn't even involved. That's a problem. Now, in an environment where tech corrects, if you get the other sectors to pick up, you may not make any progress at the index level. Hey, there you go.
I was waiting how long it would take until basketball would come.
Right away.
Eastern Conference Finals, baby.
You're not going to get progress at the index level, but you're going to get all this internal improvement going on where all these other names are going up, like a Caterpillar or the random discretionary Freeport, right? And there's alpha there. And then eventually, once tech runs its course, I would assume we go back to what we were just used to from last few months and the market resumes higher. Maybe tech takes leadership back again and those other names cool off, but as long as they're filling the void, you're not going to get a March type of correction.
Todd, we've seen this a zillion times. And then the clown show calls it the tech wreck. It's right? They can't come up with something clever now. Every cycle, it's the same thing. You get the correction in the tech leadership, the big cap names. They call it a tech wreck. Is this the end? And then we go on to make new highs.
And look, those names are extended. There's no doubt about it, right? Apple, 50, 60% of those 200 days. That's extended. That's fine. It's going to correct, but is it a huge...
not correcting at some point would be unusual. So this is perfectly normal, right?
Yeah, I think so. It's painful when it happens if you're not prepared, but it's natural in markets for stocks to correct, especially if they're cyclical oriented, right? Go back to the 90s and look what the semiconductors did. Basically, on a monthly basis, they were correcting 10 to 20%.
Yeah.
A monster run.
You saw it in the NASDAQ. That just corrected. It took 3 days. And if you look at it, pulled right back to a very logical level of, prior highs, which should act as support, and I think is today.
Let's talk about the recent rotation, Strazza. Why don't you talk about a little bit about what's happened more recently? We could talk about what started at the beginning of September, the first week of September, maybe even go back further.
Yeah. So basically back on that podcast too, Todd, you were talking about like what you guys look for coming off the lows type of thing. So like when breadth expands, do you look for different groups to kind of see rotation in different environments? So back in 2016, you were talking about the Macau casinos because of the Chinese crisis that kind of led to the drawdown that we saw in 2015-16. would you look at like the airlines today in a similar light? Or is that the trash trade and it's the opposite and that's bearish? Because Jets, the ETF, is up 10%, crushing everything else since the S&P broke out.
Yeah, so the expectation is that those names, whether it's airlines, hotels, casinos, theme parks, are going to be awful from here on out. And maybe the airlines are standing. You're seeing improvement in very modestly in the casinos, in the hotels. Disney's had a nice little run here. I think if those names are going up, are the market's expectations for what's going on in the economy need to be adjusted, right?
Yep.
And that supports the breadth argument too. So coming off a low, you want to see a surge just in terms of the number of stocks participating. We saw that clearly earlier this year. That was one of the best readings, I think, in history, as I'm sure you guys know.
Well, like in June, you had that big thrust.
Yeah, it was.
Are you talking about like in March or June?
June. Coming off the low.
We talked about that on our last happy hour, the breadth thrust.
It was records. And
all over the place, too.
Yeah, and you have to understand it's not going to. You can't view it as a divergence now if new highs don't exceed that level because it was so good. It's not
impossible to right.
Yeah, that's a historical major market low characteristic, not we're just trending higher characteristic. You can't look at that as a divergence. We should have had Todd
on with the internals conversation. Mike Hurley was saying once you get a reading like that, ignore any divergences for like.
Yeah, Mike knows what he's talking about.
So you don't really worry about divergences the first year or two of a bull market. And so while you're talking about a lot of divergences right now, they don't matter because you're your first year in a bull market and you got about 2 years to go and you can see a lot of divergences and they're going to drive you crazy, but you need to be long, you need to be strong, you need to make money.
Now, the other week, you actually had a pretty good reading in 52-week highs. I think they're the best since February. So that's evidence of those, we call them the reopen trades, right? Of those names starting to work again. And can it be short-term climactic like we've seen? Yeah, but it speaks to the durability and the broadening participation that's been going on under the surface away from the 7% Apple, the 6% Microsoft, the 5% Amazon weights. You wouldn't know that if you looked at just the index.
Right.
I think, now, here's something I think that's important when we're talking about rotation. Now we're talking sector rotation. You're seeing industrials, materials, right? Those are working. Well, what about
materials? All-time highs.
Materials unloved. Are they the smallest sector? I think so. Either that or energy, 2-something%. So they get overlooked. When
how are the geniuses on the sell side thinking about materials right now?
You look at chemicals. They're improving. There's some really good names in there too, and then there's the laggards that are starting to catch up.
What sentiment are you seeing there from sell side?
Materials unloved. You had a pretty good surge in money going into materials ETFs coming off the low just when you just bought everything. And over the last month, it's all come out. I think because they think the trade's done. To us, it's not, especially when you start looking at the components.
The chemicals specifically. They've been the leaders there forever.
The chemicals.
And the gold stuff, right?
Gold, I feel like the gold and gold names are in a league of their own.
Yeah.
If I'm talking materials, I like focusing on chemicals and the Freeports and the Southern Coppers, not the gold miners, because they just, that's
they're their own animal.
Yeah. Now keep in mind, since the March lows, in terms of just allocations, there's been about 3 or 4 times dollar amount gone into bond ETFs than equity ETFs, right? Because the Fed has helped there. They started buying bond ETFs. So if I say there's $100 billion that's gone into bond ETFs since March versus say 30 billion, those aren't the exact numbers in equities. At some point, I think those are going to adjust. So money coming out of bonds or even coming out of gold ETFs and back into stocks. So as much as we want to talk about sector rotation, what about capital rotation? I think that's something that, especially as we head into the fourth quarter, might be a serious catalyst for stocks.
So what about commercial hedgers and tens? Short as hell.
Yeah. The sentiment. I like the flow data.
What data?
Just looking at flows.
Oh, flows.
Flows into bond ETFs. The futures helps too. They're still short the S&P, I think. For whatever.
I always found that the equities is complicated.
It's
the sentiment on the bond market is cleaner, I feel like.
So I just wonder, the sentiment for stocks at least seems all over the map. Right?
Yeah.
I get the put calls, I get that, but then flows really haven't been that
Put
aggressive
call
at all.
ratio is the most overrated, overused. And it drives me nuts. I don't even look at it.
If you look at what put calls did from March 2009 to April 2010, they were pretty low the entire time. So people just, making sure they're involved, and then finally they started to spike when you had the correction in second quarter of 2010. So I get it. There's speculation going on, but I don't know if that's the end all be all. But keep that capital rotation in mind, and then that money could flow into the sectors we were just talking about, where you rotate into.
Well, what about the end all be all? What might be the end all be all is consumer discretionary relative to consumer staples. That I think is a much more useful indicator than a put call ratio. Would you agree?
Yeah, and that speaks to this reopening trade, right? Because when you equally weighted, you guys know you got to take out Amazon, you got to take out Home Depot, Nike. That's like 60% of the sector. We're looking at all the Macy's, stuff that's been hit really hard, and it's outperforming the market. It's outperforming defensives. That is telling you that these expectations that they have for the economy need to be adjusted, and it's reseeking, right?
Is outperformance out of consumer discretionary at such an alarming rate? Is that bearish for equities historically?
I would say no. I would say no. Then it's a strong sector.
But Todd, in terms of what it means for the indexes, right? So if money's going to flow into stocks, like you're saying, you would think it would flow in at the index or ETF level.
Mm-hmm.
Wouldn't stocks and XLK, the mega caps just get bid up naturally because, just due to market dynamics? And then if, say they don't, the kind of stocks that you're talking about, they can't make up for if tech or communications or, Google, Facebook, Amazon become a source of funds. How are these smaller sectors like materials going to matter if higher?
So I mean, it's a good question on where the money would go. It probably goes into the S&P or the Qs, right?
Yeah.
But you might have some folks who may want to make a more focused sector bet. That we don't know, but I get your point there. Now, again, it comes back to if you have tech come in, as long as the rest of the sectors, these sectors that are 7 to 10% of the index, as long as they're still chopping around and going up, you're okay. Right? You're just treading water there for the index. You're not going to crash, and then that's when the XLK and the Qs start to correct like they have these last few days. You got to watch the equal weight S&P because that'll give you a much better tell of what is actually going on besides people unwinding very, very extended names.
Right.
I think what may be overlooked from the last 3 days is that breadth hasn't been that awful.
Yeah.
Right? Not major distribution like you saw in March, where it was everyone is getting out of here. Right, we were rushing for the doors. Hasn't been great, but it's way different from what we saw in March. Pressure on favorite names, but you're still seeing these random, like Caterpillar, I think was up the last couple of days, right? Yep. That name probably wouldn't be up if we were all panicking. Like
if the world was coming to an end, would Caterpillar be breaking out of bases to multi-year highs?
It was a big issue. I think you'd see that come in. You'd see Deere come in further, and it hasn't happened these last few days, which I think is pretty impressive, and it speaks to this bid for these other names that are outside of tech and communications.
All right, let's go dumpster diving.
Mm-hmm. My favorite.
Regional banks closed August at an all-time relative low.
Yeah.
Okay. Barely though, by like hanging on by a thread. The XLF relative to SPY, so financials relative to the market, got down to the 2009 lows and are starting to outperform starting to September. Is that outperformance just an aberration, or is the fact that on a relative basis, financials just retested those historic 09 lows, and now for the first time in what feels like forever, you're going to see financials outperforming? Yes or no?
That would be nice.
Nice for who?
The market.
Okay.
Right? Not necessary, but if you're playing for that, yes. Here's my I like to call the financials the 3 and out team now, because every time it looks like they're about to mount a drive down the field, They just go 3 and out. They get a first down, that's it. The series is over. I think they've held up in terms of just not breaking down kind of well, right? They've had chances to roll over multiple times throughout this whole process over the last 6 months, and they've held in there. So the defense is still good. But I struggle to want to dive in on those names. Now, the street hates them. They're one of the most hated groups out there. When you take all the analyst ratings for all the industry groups, right? So we go a level down from the sectors. They are usually towards the back, along with like utilities, because utilities just aren't really that covered. So the bar is very low for them, I would guess. I think it's interesting that rates just haven't really done anything.
You stole my thunder. I was going to ask you. I know you and Varone always preach not overthinking things. But let's overthink things. So let's take it there. So regionals, financials start to outperform for the first time in forever. Commercial hedgers in U.S. 10-year yield are super net short. One of the biggest net short positions ever. Is flip the book short bonds. Flip the book short bonds?
Makes sense with materials outperforming like we just talked about.
There's these little hints there, right? The cyclical sectors, copper
outperforming gold.
A lot of, like you're saying with the hedgers, there's a lot of money going into bonds. At some point, that's going to reverse. I think it's interesting that the rates just haven't gone anywhere. So if we're talking about volatility, I'm sure there's more professional people here, but to me, that's just a tight rubber band, right? Eventually, it's going to snap back. If these little clues we're picking up are right, then you should get a lift in rates. I guess that's going
to help. Back to 3?
It should. With that, how about we get to 1 on the 10-year?
And what does that mean for financials? Did they finally start to outperform?
That should benefit them.
Right?
I mean, that should benefit them.
Higher rates, higher commodities. Right? Higher financials on a relative basis, industrials on a relative basis, emerging markets relative to outperforming?
EM, now, I think
Speaking of dumpster diving.
EM, you got to look at the constituency. EM. We've gone from this commodity base to now tech with Tencent and Baba and Samsung, right? But that's another place that's coming out of a 2.5-year bear market. I like it. Do I think it can outperform
longer, arguably, right? Zoom out even more.
Yeah. Oh, yeah. Going back to what, 08, 07?
Yeah.
So it's called a cyclical move here. Can it outperform the U.S. over the next 5 years? That's a harder question. I'm not sure, but
you know that we're down on I don't know if you noticed, we're down on a relative basis to where the EEM launched in 03. Mm-hmm. We kissed that launch open relative.
Constituency. With EM, with even Europe, you got to go, I think, at the country level, especially when there's not Apple and Amazon in those indices. I mean, there is Baba, but I'm talking more specifically of Europe. They don't have these crazy tech names.
Well, there's more financials oriented, right?
Yeah, they stunk.
Well, that speaks to a larger theme, like just what you're talking about. We just went from financials, then you started talking about EM, Europe. Aren't all these things the same? Don't they just come down to tech versus financials? Whether it's growth versus value, large versus small, U.S. versus world.
It's all the same thing.
Right? Is it just like, should we just be looking at tech versus financials? And not
I think that's fair, especially if you're talking growth and value. That's what it comes down to.
But even internationally, I mean, you know more about index construction than anybody I know. Aren't the weightings a lot heavier towards banks and financials?
Yeah, well, in the stock 600, it's heavy financials, heavy industrials, and staples. So, and the industrials are actually pretty good looking, like a Volvo. It's a pretty good chart there. Staples, I mean, who really wants to get overweight staples?
Right.
It's just not. Yeah, there's good names, but it's just not.
Clearly not the long only buy side.
Yeah, right. And then you're stuck with the financials.
Right.
And then the consumer discretionary names there are mostly these autos, which have struggled for a long time. And then the luxury good names.
It's because their autos aren't trying to go to Mars. That's the thing.
They're not Tesla. That's it.
If they were trying to build cars to go to Mars, maybe those indexes would look better.
It would be much better. So it's these constituency issues. So it's tough to just say, oh, let's just go out and buy EM or Europe or Japan. You got to go a level lower. I think in this type of environment, especially if you're benchmarked to the S&P.
Okay, let's stick with the dumpster diving and talk energy.
Oof.
Look at that face.
Look at that face.
He says it all. He's like, do
Well,
we have to talk about energy?
Well, no, let's pose it this way. You talked about some rotation into cyclicals, right? And how that would make sense right now. When I'm looking at a chart, we'll overlay it on the video. Financials are outperforming recently, materials, industrials, and then energy's on the bottom left of the chart as if it's been completely left out. Isn't it cyclical? Is it not a part of this group?
Is Dow Jones smart for kicking out Exxon, or are they going to regret it?
No, I think
Does
the better
energy need to merge with materials, and I think they also
that should happen. Number one, I think, as you said, for Exxon, the better trade there is Pfizer. It's a better chart, and that got kicked out.
Yeah.
Forget Exxon. We said the same thing about GE however many years ago, and that stock has been terrible, right?
Garbage.
I don't know why. Unfortunately, it's looking like it.
Okay.
energy,
Unfortunately, for who?
That's there.
The company.
Oh, that's there. That's not our thing. That's there.
The energy let off the low. That was just the total buy everything, and the market's just not with it. And I think when you have these cyclical areas working, and then there's one space not working, that's the red flag to say, don't even bother touching this thing for now.
Yeah. And there's nothing there, nothing oil services, refiners, nothing stands out?
The gas names had a nice little run there, I think, a few weeks ago.
Solar.
But nothing speaks to me, and maybe I got to take a deeper look, nothing speaks to me as much as I'd rather say be buying industrial.
Money's in solar, right? Which is tech.
That too. I mean, if you take your technical hat off and just think about what's going on in the world, that's the stuff that people, I think, are aiming for.
Try not to do that.
Is solar
I get very confused like that.
Todd, is solar really tech or energy? I know some classifications have them as semiconductor stocks.
Yeah, there's First Solar, I think, is a semiconductor.
A lot of them.
Right.
So I think it depends on the fund or the classification. Is it GICS or is it Russell or the ICB? All these different classification systems.
So bottom line, they're tech.
I think you call it tech if they start trading like that.
You know what they are? They're solar is what they are. Let me ask you this. I look at them like the gold miners. Like you said about the gold miners, very similar in my view.
Yeah.
Kind of their own animal. All right, let me ask you this. Let me try to do some inferring and some assuming, because that's always good. Based on what you're telling me, you think we're getting this rotation in emerging markets, industrials, materials, potentially even financials in a perfect world, and then ultimately the communications, discretionary, tech comes back. You see those highs, and by then now you're seeing a rising tide lifting all boats. So we're talking S&P 4000, right?
Yeah, you have to.
Hey, thanks for watching. This episode has a part 2, so be sure to find it in our playlist called Happy Hour with Traders.